All right, so let's get a little bit more in depth. Right? So let's go back to our Deloitte document. Let's go back to that 4-step process that we identified. That was down, it's right at the very beginning of the document. It's right here, the functional currency approach, right here on page 3. And here's our 4-step program, right? So the first step, identifying each distinct and separate group within the consolidated group, that's a judgment call, right? You got to look at the org chart, you've got to look at the nature of the operations, and if you're just trying to figure out as an auditor or as a brand new person looking at this company, and it's a public company, I can specifically speak to public companies because there's information out there. The way to get this information is by going to item 1 in a 10K. Item 1 in a 10K. Item 1 will have a listing of all of the properties, the locations, how many people, what they're doing. It's a wealth of information. Item 1 of the 10K. But that's a critical piece. And if you're an auditor, you want to make sure that your client is able to do a good job in identifying each of those distinct and separable operations within the consolidated group. That's the first step, and for some organizations, that's a big deal. For most, probably not. They probably can identify where their operations are, they've been there, they've been doing it for a lot of years, it's not that big of a deal. The next step, again, another judgment call, right? There's a lot of judgment involved. There's not a right answer. There's judgment involved, and it comes down to defense. Determine the functional currency. After you've identified these distinct and separable operations, now we have to figure out what's the functional currency. Well, how do you figure out the functional currency? I mentioned this before, but we're going to take a little bit of a deeper dive. So let's go take a look at our codification. And we're going to go to our broad transactions. We're going to go to 830. And we're going to look at the overall. And there's some broad discussions about functional currency up in other presentation matters, but I want to go to the implementation guidance. And this spells out, now it's implementation guidance. These are not hard and fast rules. They're trying to get you to think about what are the things that you need to evaluate to determine what is the functional currency. And the real issue is we're looking at the entity and we're looking at the entity's relationships with its parent company. Now, not all subsidiaries report directly to the main parent. So if we think about some types of organizations, you may end up having a parent company, the worldwide parent. And the worldwide parent may have a variety of operations. We'll call these Op 1, 2, 3, 4, 5. And that may not be where we stop, because in Op 1, they may have 5 operations, right? So this is Op 1-1 to 1-2, 1-3, and 1-4. And over here, this one may have 2. So this is Op 5-1 and 5-2. On and on and on. This may be a Mexican operation. This might be a German operation. So this German operation, this Mexican operation, as well as whatever we've got here, is 100% owned by this operation. So this ends up being the parent. And if this parent is a Chinese operation, right? Then we have to take a look at, well, what's the functional currency for Operation 5-2? Is it the German currency or is it the Chinese currency? And then we've also got to look at this operation here, Operation 5, and figure out is the functional currency of this operation, is it the Chinese yuan or is it the US dollar? Same here with any of these. So we got to look at each of these separable and distinct operations and figure out what is the functional currency of each as it relates to the entity and the parent. So the entity and the parent of that entity, not the consolidated parent, because this may there's multiple levels of ownership, and so this entity reports up here. They create financial statements, and then those financial statements are then consolidated into the parent organization, the big parent organization, the daddy parent, if you will. So we've got to identify for every single one of these distinct and separable operations, and there could be some stuff here in 2 and 3, but we're just going to leave it 2, 3, and 4 are their own entities, and they don't own any subsidiaries. But so what we've got here is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 individual subsidiaries and a 12th parent. So we can figure out what the parent's functional currency is, and then we can figure out what all of the operations' functional currency is. And then anything that is, we're going to figure this out in a moment, if any of these operations have foreign exchange transactions or any kinds of transactions recorded in a foreign currency other than its functional currency, they have to be remeasured, and the cash flows adjusted, the income statement adjusted, all of that stuff, just like we did with foreign currency transactions. Let's go back to our implementation guidance. Because now what we're doing is we're looking, and we're going to scroll down here a little bit. We're going to scroll down to determining the functional currency. Understand, this provides guidance. These are economic factors. There may be others, and they have to be considered both individually and collectively when determining the functional currency. Is there an answer? No. It's a judgment call. You have to make the argument. And what they do in this guidance, in the implementation guidance, is they identify 6 items: cash flow indicators, sales price indicators, sales market indicators, expense indicators, financing indicators, and intra-entity transactions and arrangements and indicators. And they give examples, just examples, right? These are not rules, just examples. It still requires your judgment. And so obviously you can read these yourself, but let's at least look at the first one. Let's look at cash flow indicators. What would make for the functional currency be the foreign currency, right? So if we go back to our previous example here, right? We're trying to make a distinction between, if we put back up our little thing, we're trying to make a distinction here. Is it for this German subsidiary and its Chinese parent? Is it the foreign currency, the German currency, that is the functional currency, or is it the parent's currency, the Chinese currency? Right? That's what we're trying to make a distinction. When we get up to here, it's going to be different, right? We're going to look at this entity, and we're going to look at this entity and say, okay, is it the foreign currency? Is it the foreign entity's currency, the Chinese yuan? Or is it the parent's currency, the US dollar? So, and it's quite possible that in this relationship, the German currency is indeed the functional currency. It gets translated to the Chinese yuan. But then when you get here, the Chinese yuan is not the functional currency because of the literature. It's really the parent's currency, and then we have to remeasure the parent's Chinese, the Chinese organization. We have to remeasure that after it's already been translated for the German entity, and the German entity had its own functional currency. Boom, that's going to blow your mind. But is that possible? Yes, it is possible when you're looking at multiple layers. So we're always looking at the parent and the subsidiary. And there may be multiple levels of parent in these types of organizations. Let's go back to the guidance here, and specifically looking at the idea of cash flows. Let me increase our, how big this is so we can take a better look at it. There we go. All right, so for the foreign currency, if it is the foreign currency, cash flows related to the foreign entity's individual assets and liabilities are primarily in the foreign currency and do not directly affect the parent's entity's cash flows. Well, what does that mean? Well, basically, they're doing all their stuff. It's not altering the cash flows of the parent entity at all. It's really, it looks like it's self-contained, right? The cash flows are self-contained within, let's say, that German subsidiary. Well, if it is the next one, then it's not going to be, the functional currency is not going to be the euro for Germany. It's going to be the yuan. Because if the cash flows related to the foreign entity's individual assets and liabilities directly affect the parent's cash flows currently and are readily available, and this is what I like, that money can be taken immediately from Germany right to China and used. That would suggest that the German subsidiary does not have control over its cash. Does not ultimately control the cash going in and out, right? It's the cash flowing in and out of that German entity is available to go right to the parent entity. That's it. That, to me, that's a key that would suggest that you have to use the parent's currency for that German entity, right? So what would happen, right? Let's go back to our little crazy schematic that I created here. If that latter thing happens, this German entity, we would have to remeasure all the assets and liabilities, all the revenue and expenses from euro to the Chinese yuan. And we're going to talk about remeasurement, how we're going to do that. And then everything's in the Chinese yuan, then we would consolidate the German entity and the Chinese parent. Just basically add the sales together. If there's any intercompany stuff, right? So if the German company sold to the Chinese company, or the Chinese we bought some things from the Chinese company, we'd have to eliminate those kinds of those types of transactions that are intercompany transactions, because those are not, that's not affecting the economics outside of the organization. That's just, we're just trading with ourselves. So all that stuff has to be eliminated. But after you convert your German subsidiary to the Chinese yuan, because we determine that the functional currency is not the German euro, it's not the euro, it is the Chinese yuan, then this has to be remeasured. And again, it's a judgment call, right? All of this is a judgment call, how you want to, sales price, sales markets, right? Who sets sales prices, right? If the parent company, if the Chinese company is setting sales prices for the German subsidiary, right, in euro, then that's an indicator. That again, it's not the only indicator, but it's an indicator that would suggest that the functional currency is not the euro, that the functional currency is indeed the Chinese yuan. So this is a significant discussion when you get to doing consolidations in foreign currency translation and foreign currency remeasurement.